Well, welcome to the More to the Story podcast. I'm so glad that you have come along. We have a very interesting, helpful show for you today. Not the type of show that I typically do, but I think it's something particularly those of you who are in leadership positions with institutions will find incredibly helpful and something we all need to think about. Okay, but before I do that, I want you to know that this podcast is brought to you by Wesley Biblical Seminary, where we are developing trusted leaders for faithful churches. And in addition to our ATS, Association of Theological Schools accreditation, we have just been accredited by the Association of Biblical Higher Education, and we're excited to have that. That means our undergraduate program is now accredited as well. So we have bachelor's, master's, a variety of master's degrees, and a doctor of ministry degree. And we would love for you to think about coming and joining us, being a part of various things that happen here at Wesley Biblical Seminary. Also, I'm thankful to WPO Development for being a sponsor of this podcast. Their CEO, Keith Waters, says if you don't have a plan, any path will get you there. And he does that through a variety of programs, including capital campaigns, feasibility studies, and mission planning studies. He's done successful capital campaigns for more than 250 organizations, churches, schools, nonprofits, all around the country. So I encourage you to check them out at WPOdevelopment.com. Actually, you Google WPO Development or you go to Keith Waters at WPOdevelopment.org. All right. Well, I am so glad to welcome to the podcast my friend, Ethan Kelly. Ethan, welcome to the podcast.
Nice to be here, Andy. It's an honor.
Well, Ethan serves here at Wesley Biblical Seminary as a vice president for business affairs, business services? Okay, make sure I have that right. Okay. Now tell us a little about yourself. Like, how do you get into a role like this? Like, what is it in your life that led you to be in this position?
Oh, that's a great question. You know, the role here at WBS is rather broad. So I occupy the CFO seat. I also serve as head of HR and general counsel for the school. And so I wear a lot of hats here in the building. And I also serve as CEO of Providence Capital Management, my own investment advisory firm, and I work with institutions on endowment and foundation management and high net worth individuals.
Gotcha.
But it's been to answer your question though, it's been a long and winding road.
Because your path to this spot isn't exactly like predictable.
Yes, it's not predictable. So, like you, I went to Asbury.
Right.
I was a few years after you.
Thanks for the reminder.
But I studied history, political science, and economics at Asbury.
Okay.
And loved it. But you know, I always wanted to go into investing and financial management.
Okay, interesting.
You know, at least once I started taking economics classes at Asbury, I realized this is something I want to do. You know, did a summer internship with a local investment firm, really fell in love with it, but I'm from a family of attorneys. You know, both my parents are attorneys. And so I always grew up wanting to go to law
Both your parents are attorneys.
Yes.
Now, this is unique. And you're homeschooled, right?
Yes. So
homeschooled by two attorneys.
Yes.
Okay.
Yes.
This is all right. So anyways, keep that in mind. But yet you have this interest in investments and interest in the economy and history and all these type of things.
Yes.
These are now, and of course, let me just back up. You have like some special, and many people in my audience would be aware of the Asbury University history faculty. They'll and you were there with some of the lions of that department. Why don't you go ahead and give them a shout out there? Who meant were meaningful to you?
Yes, I was there with the big three. You know, Dr. Spann, Dr. Reynolds, and Dr. McKinley.
There you go.
And love all three. Keep in touch with them. And yes, just had classes with all of them, and it was great, fantastic. I maintain a written correspondence with Dr. McKinley.
Wow.
And
even his, so I'm guessing you've gotten some of his very stylized quill pen.
Absolutely.
Yeah.
Absolutely.
Oh, right. Yeah.
Yes.
I have a stack of those that I have kept because they're so special to me that I got from him.
I've got a stack of his letters. And you know, I mean, our correspondence goes all the way back to, you know, my senior year, wrapping up senior year of college at Asbury.
Wow.
He was retiring and let me have the pick of his library. And so
my goodness.
So I got to pick some books from his library, you know, because we were, you know, I was a student of his and, you know, one of my majors was history. And so he just, you know, needed to downsize his library. And so I wrote him a thank you note for letting me, you know, pick from his library. And he wrote a response to the thank you note, and we've been writing ever since. So,
yes. Wow! I don't mean to detract.
No.
It's so interesting. These are people who help form you, and these are people who think broadly. And I think of Dr. I don't know Dr. Span as well. I know his family, obviously connected to WBS, but these are people who think broadly about the world and care about economics, care about politics, all these things you're kind of interested in. That, and I think that kind of worldview training was a part of what launches you to be at a place like WBS.
Absolutely, because when I was at Asbury, I realized, I've always been interested in history.
Okay.
But I realized that, I wanted to learn how the world worked, and history was a big part of that. But so was economics, so was political science. And so I wound up kind of developing, I tried to craft for myself kind of this well-rounded curriculum, if you will. And credit to Asbury, the history major was small enough that you could add other majors and minors to it, so you weren't limited to just one major. And so I was able to double major in history and political science, and then double minor in business and economics. Took calculus as well as an elective, and statistics and all that. And it was just a very well-rounded education I got at Asbury, and they're fantastic at that. And so and I was privileged to get to have Dr. Span and McKinley and Reynolds, teaching me. And of course, Dr. Clements was over the political science.
Oh, right, sure.
He's still there. Even though I didn't major in literature or English, I had multiple classes with Dr. Dan Straight, which were fantastic. And of course, a number of economics classes as well, and accounting classes. Prof. Walsh is the accounting professor at Asbury. She's still there. And fantastic accounting professor. Accounting class is actually where I got to know my wife.
Interesting.
That's where I met her. So anyhow, not to go too far off the path on Asbury memories.
This sets you up.
But yes,
this sets you up for like the way you think about the world.
Yes.
And then you go on to law school.
Yes.
Mississippi College, is that right?
Yes. MC Law. Yep.
And so all of this though, like maybe not practicing law, but thinking of investments all along the way.
And I did practice law for a little bit. Well, out of law school, I went straight into investment management. A local firm hired me, took me on. I was with them for several years. But then I decided that I wanted to start my own firm. So I started my own firm in 2019, towards the end of 2018, beginning of 2019, transitioned out of the old firm and started practicing law with my parents to help pay the bills while I set up my own investment advisory firm. And at the same time, I also decided I needed more education. That I had a great foundation from Asbury. And then I added to that with my law degree, which, I focused on estate planning and business law and stuff in law school. But I felt like I needed a more investment-focused education. And so at that point, I enrolled in Yale School of Management and did a online program called the Certified Investment Management Analyst Program. It's the CIMA. And it's like a CPA, but for investing. So it's a designation program, not a degree program. And it's partnered with the Investments and Wealth Institute. And so I did that while also, I've treated it like a job, honestly. I did my Yale work in the mornings and then went and practiced law in the afternoons. And in the meanwhile, also running my investing business as well. And working on a consulting basis with my old firm because they still needed me to help out on a few things. So I was wearing a lot of hats and... No
children at the time.
No
that was
kids.
all on that. But now you have Sophie. So maybe
now I have Sophie. So I'm glad I did that then. Glad I finished my education before having kids. But it was very busy time, but it was a very rewarding time, very formative and educational time. And, once I, finished with the CIMA program at Yale and had kind of gotten my feet under me, setting up the business and everything. And, I started, trying to get clients. And so one prospective client on my list was Wesley Biblical Seminary.
There you go.
WBS had just gotten a new president.
Right.
An endowed institution. What I wanted to do was help endowed institutions, especially Christian endowed institutions, manage their money better. And so, this is several years ago now, but I reached out to Matt Ayers and said, "Hey, let's meet." And we hit it off immediately. And he said, I would love to have you be our endowment manager. What I really need is a CFO. You can keep your investing business, please, keep doing that, but would you be our CFO? And so I said, sure. So I retired from practicing law. I say retired. At the right, in my early 30s, but
just couldn't take it anymore. Couldn't take the law.
I stopped practicing, and who knows? You never know if you might pick it up again one day. And I still use my law degree on a general counsel basis for the school. But yeah,
I know.
Yeah, yes. So I stopped practicing law to make room for the CFO role here at WBS, and I've still been growing and developing my investment advisory business with a focus on institutions, foundations, endowments, and high net worth individuals. Yes.
Interesting. So it's interesting to think like you have this focus, particularly on endowments.
Yes.
So there are people probably listening to this who are part of like small nonprofits, churches that are like trying to set things up. And a lot of times, like a pastor, I speak from experience with this, like, somebody will come in and say, I want to leave this in my will, but here's how I want it to be. Or I want to have this money, but I want to leverage it as much as I can. And my thought is, oh my goodness, I don't really want to think about this. I'm honestly, forgive me.
You're good.
You do. You do want to think about it. And you do want to think about endowment. So why is it important for us to think about endowments?
Yes. So it is important. And I know there's the running joke when Jesus comes back, he's going to ask, what am I going to do with all this endowment money?
Right. Sure, it's a good question.
Yeah. So obviously you don't want to make endowments the focus of your ministry.
Right.
But endowments as a tool for your ministry are incredibly important. To establish a certain sense of longevity with your ministry, to allow you to be free to do what God put you here to do. If you're a school, then offer scholarships to students so that they can, get out of school with less debt. Or if you're a church, to support missions or support, local charitable activities to help out with your local community. Whatever it is, it's there to provide freedom for the institution to do what it's supposed to do.
Yeah.
And so as long as an endowment is viewed in that sense of providing freedom to fulfill the original core mission, it's a not only is it a healthy focus, it's a focus that endowed institutions should have, so that they can have that freedom, so that they're not hand to mouth constantly trying to just make it every month.
Yeah.
So that they have the freedom to actually focus on what God has given them to do.
So you think about it as a tool.
Yes.
Like the endowment it's not just me hoarding resources away from somebody else. It's a tool. And what is that? And when you have an endowment, it's also doing something for the society. It's accomplishing something in the economy. What is that?
Yeah. So, I like to look at, say for a school, for example, I like to look at it as a three-legged stool.
Okay.
You want three revenue streams. You want tuition income, you want donation income, and then you want endowment income. You want and so that if one falls short, the other two help it along.
Sure,
and
great way to think about it.
Yeah. So in the economy of a school, that's the role it plays. Is it takes pressure off the fundraising office. It takes pressure off the student recruiting office. And again, that allows those offices to focus a little more on what their true vision is for the institution and program. And so, and of course, you are investing in the broader, national economy. You're actually investing, the assets of the school into, the stock and bond markets and all of that as well.
Now, some of us, like in my seat, like I have, retirement accounts, that kind of thing. Like I definitely want to do all that I can to plan, but all that I can is different than all that you can, like with your experience.
Right.
And there's a tendency maybe for somebody in my seat or who's been in the seats that I've been in just to say, well, you just go and do some good work, and I expect to see a nice return.
Right.
But like, how do we, from a policy perspective, approach our endowments? Like, how would somebody who is like the CEO or in leadership of a church come in, a CEO of a nonprofit or an institution like a school, come in and give you like a policy directions?
That's a great question, and many institutions have what's called an investment policy statement, where the CFO or the board or the investment committee of the institution draft a policy on allocation limits and how they want the endowment, broadly speaking, not micromanaging the managers, but just broadly speaking, how do they want it invested and managed? Mm-hmm. And I think the best way to illustrate that is by telling you a story.
Okay.
So it's 1940, it's World War II, and right now the Brits are fighting alone. It's them versus the Germans, and they have no allies on continental Europe.
Right.
The Russians haven't entered the war yet, and of course neither has the United States. However, the Italians decide they're going to invade Greece. And so the Italians invade Greece in 1940. The Greeks actually beat them back. And so, and at the time, Italy is much bigger than Greece.
Right, sure, yeah.
So it's a big win for the Greeks. And the Brits are, of course, thrilled because, hey, we have an ally on the continent that we can start sending troops to and help to and fight against the Germans. Well, of course, the Italians are allies with the Germans. They go to the Germans, bring them in to help out. And so now it's Britain and Greece fighting Italy and Germany. And the British are sending supplies to Greece. So here's the relevant point. The British are unloading ships in the port of Salonika. They're unloading supplies to reinforce the Greek army and the British troops that are in Greece, preparing to fight the Germans. The Luftwaffe, of course, gets word that the British are in the port unloading all their stuff, and so they come to pay a visit. And, the anti-aircraft fire is fierce, and their ships spread throughout the port. Each ship, they're not connected to each other. They're each separate from each other. But the German Air Force comes in and they hit one particular British transport that is in the process of unloading 500 tons of TNT.
Oh, my goodness.
They blow up. They sink. It's a massive fireball. It's just massive destruction on the port itself, obviously the ship, and it exploded and took about half a dozen ships down with it.
Wow.
Those ships before the explosion were all very different from each other. They were all different sizes.
Right.
They were all floating separately from each other.
Yeah.
But they were ships.
Right.
And when that 500 tons of TNT went off, they suddenly became highly correlated assets.
Oh, man, you're sneaky.
Yes. And so that can happen in a portfolio as well.
Okay.
Is you might invest in a bunch of different stocks, but they're stocks.
Yeah.
And if the financial equivalent of 500 tons of TNT goes off, all those stocks could go to zero or at least have a significant drawdown. 2008 was a great example. Heck, Q1 of 2020 is a great example. The fastest bear market in U.S. history happened in February and March of 2020.
Amazing. Yeah.
And it was because of a broad systemic event that happened that affected the entire stock market. And it brought down, wreaked absolute havoc on investor portfolios. So what is the solution to that then? Well, the solution is to have a variety of asset classes. Mm-hmm. You don't want to be just in stocks, even if the fund you're in has dozens or even hundreds of positions.
Yeah.
If you're in one asset class and something systemic happens to the market, then it doesn't matter how many stocks you're holding. You're up a creek. And so you want to diversify your investment into non-correlated asset classes to reduce the overall volatility of the portfolio.
Sure.
So that's where you get into, okay, we're going to establish allocation limits. We're not going to let a manager put 100% of the portfolio into equities.
Sure.
We're going to have a certain required threshold for fixed income, for bonds.
Yeah.
You could even work in commodities like gold or oil or something or even real estate, publicly traded real estate investment trusts. You can work that into the endowment to reduce the correlation levels so that, again, kind of like a three-legged stool, if one leg gets weaker or smaller, well, you've got two other to kind of help out.
Right.
Obviously, you don't want any one leg to go away completely, you'll topple over, but you want to have different asset classes built into that endowment. And each investment committee, each institution is a little different in how they want those allocation limits to look.
Interesting. So when you think about investment committee, a lot of people are needing to find people to serve on those committees? Like board, maybe it's not all board members, board trustee members, but maybe it's just a special committee that comes together. Could you advise us like how to find those type of people? Like,
yes, that's a great
question.
Who
do you want to have on that committee?
That's a great question. You obviously want people who are financially savvy, people who have experience with investing either through their own portfolios or professionals.
Yeah.
So, you might have some investment advisors on that committee. Or you might have a CPA or two, some attorneys. You want people that understand markets, that understand money management and managers, that aren't going to be intimidated by reading an investment policy statement and kind of understanding what the general rules are.
Yeah.
You don't need to go find somebody that's Warren Buffett.
Yeah, sure.
Sometimes maybe people get intimidated by the idea of, oh, well, I've got to go find somebody who's an expert in this one thing. And it's, well, start with getting people who are financially savvy enough to read the investment policy statement, understand it, and be able to hold the managers accountable.
Right. So there's a little bit of that, like holding people accountable. And there's a characteristic within their personality too that probably needs to be there, like that they're willing to.
People that are willing to have honest conversations.
Yeah, sure.
And including accountability conversations. But at the same time, people that aren't hotheads.
Wow.
Because, when I was in Yale, one of my professors was a retired endowment consultant. And he specialized in consulting with endowments of $100 million and up. And built a very successful career doing that. And he told us a story about how he was consulting with one endowment in particular, and he had all the metrics, set up for evaluating endowment managers. I mean, way more detail than most institutions would want to go into.
Yeah.
But he had it down to a science so that as soon as a manager started underperforming, he'd fire him and go and hire another manager, to take his place. So he had this whole process for search and selection of managers. Only the guys with the best metrics would get hired, and anybody that started slipping would get fired.
Okay.
Well, a few years in, the endowment fired him.
Wow.
And he's like, why did I get fired? I'm, at the top of my game. I've got all these metrics. And he started looking at it. He started looking at his history with that endowment. And what he was doing was he was too quick to pull the trigger. He was firing endowment managers too soon. He was essentially buying high and selling low. You fire the guy that slipped up just once.
Yeah.
And which happens to be when his portfolio is lower, and you go and hire the guy that just had, hot numbers, and you're investing in whatever he just had success with, so you're buying high.
Yeah.
And so you don't want hotheads. You don't want people that are just going to fire somebody the first chance they get. But at the same time, you want people that aren't just nice, get along people that aren't going to ever make a decision.
Yeah.
Because it's very important for an institution to have a well-managed endowment. And honestly, especially after a year like 2022, there are a lot of poorly managed endowments out there where a change needs to be made. Where you might have had somebody that, was a friend of one of the board members or something.
Right, that can be a weakness too.
That got put on there, and honestly, their focus is not on nonprofits. They just kind of help, normal people out, and hey, that's great, but maybe they don't have a lot of experience working with nonprofits, and they didn't do a great job.
Wow.
And you need people that are willing to say, okay, this person's been with us for a number of years. They're underperforming. We need to make a change. But at the same time, you don't want to be quick-tempered and firing somebody just the first time. They're great, and then suddenly they start slipping. So you want somebody that's discerning enough to balance between the two.
Gotcha.
Yeah.
So it's just thinking about where we are now. Like since 2020, you talk about that terrible bear market.
Yeah.
And then we come out of that, but yet we're still struggling. Now we have the situations that are going on with Russia and Ukraine and these various places and administration. So I'm trying to figure out, where are we? Like, what's going on? And I honestly just get totally lost in it, and I'm just hopeful that when my retirement account comes back, there's a little bit of growth and not too much of a loss. Although there's not been too much of that growth.
Not much growth in the last year or two. No. That's a great question. So we'll start with 2020, the first quarter of 2020. Fastest bear market in U.S. history. I mean, watching the market collapse, I mean, on a day-to-day basis was incredible, absolutely incredible. But
it's like a disaster.
It was
it's like a natural disaster.
It was like a natural disaster that was significantly impacting markets. And the Federal Reserve stepped in. And for those that don't know, the Federal Reserve is the central bank of the United States.
Right.
And so the Federal Reserve steps in and essentially just started printing money like crazy to prop up the financial system. And what they started doing was they were going out into the marketplace and buying securities. So they were buying $120 billion a month of securities at the pace of $90 billion a month in U.S. Treasuries and about $30 billion a month in mortgages. They were pumping money into the mortgage market. And so what that did was and they dropped rates to near zero. What that did was it stopped the collapse. And of course, around that same time, people start realizing, COVID is dangerous, but it's not going to wipe out the population or anywhere close to, a substantial, it's not even going to be a majority. They realized the unknown is such a fear factor in the market. And the more COVID became known, people started getting more comfortable. But also the Fed is just dumping money into the market. And so it created this massive bull market right after the fastest bear market in U.S. history. So 2020 actually turned out being a positive year for the market.
Wow.
Because they just flipped it so fast. And then 21 was positive. But you got to, and all through most of 2020, all through 21, the Federal Reserve is printing $120 billion a month and buying mortgages and U.S. Treasuries with it, and just flooding the market, flooding the system with money. So money supply is going up. The number of dollars floating around in the system are going up, and that creates inflation, right?
Sure.
When you have more and more of the same currency, then that currency gets a little less valuable.
Sure.
Especially if money velocity, the speed at which that currency circles around the economy, goes up as well. And over the last year or two, it actually has gone up. And so it had been declining for a while, but now it's actually going up. And so when you have an increase in money supply and an increase in money velocity, you get inflation. And so, and a great illustrator of this, because this is all kind of academic, a great illustrator of this is that the median, the middle, U.S. home sales price at the end of 2022 was $467,000.
Wow. Okay.
Half of the homes in the United States in the last quarter of last year
$467,000
were selling for above $467,000. 10 years ago, it was $250,000.
Wow.
10 years ago, the median U.S. home price was
that's inflation.
Yes,
that's connected to inflation.
That is, now the headline inflation rate. Before popping on here, I went and did the math real quick. The average CPI inflation rate on an annual basis over the last 10 years is around 2.5%.
Wow.
So not very high, but if you look at this really important asset class, homes, you have one, I have one. They went from $250,000 to more than $467,000. What happened to the American dream, Andy? I mean, how are families supposed to buy a house when half the homes in America are $467,000?
No, that's right. People are dealing with this
and
right
so, now. So that is very inflationary, much more than the official numbers might tell you. And the Federal Reserve is very aware of that. And so that's why, starting in 2022, the Federal Reserve started reversing all that they had done in response to the COVID pandemic. And so they started raising interest rates, and they're still raising interest rates. And they've also started, not only have they stopped printing money, they've kicked it in reverse. They are pulling money out of the system. So they went from buying $120 billion a month in assets to redeeming $95 billion a month in assets. They're pulling out of the system about $60 billion, up to $60 billion in treasuries, and up to $35 billion a month in mortgages. And so what that's doing is it's shrinking the money supply. So rates are going up, money supply is getting smaller. It's a very gradual rate. It's not a big shift. Year over year, the M2 money supply is only just now, kind of in the fourth quarter of last year, just now started shrinking. But that is expressly for the purpose of fighting inflation.
Okay.
Because, you can say what you want about oil prices. You can say what you want about the price of eggs and price of groceries.
With that too, yeah.
But like housing is strictly like that big cycle, that big bull run is strictly attributable to the Fed. You can't blame Putin for that one. You can't blame the Middle East. You can't blame the avian flu, like with eggs. Nope. Housing went from 250 to more than 450 in 10 years because we just printed too much money and flooded the mortgage market with too much money.
So are houses really that valuable? Like if you're...
That's a great question because, at the same time, post-2008, home builders slowed down building homes.
Right, exactly.
Because a lot of home builders got wiped out in the 2008 crisis. So you've got the millennial generation coming forwards and buying homes for the first time.
Right, sure.
And so, you have a lot of demand, picking up for homes. And so, are homes worth $250,000 like they were 2 years ago? I highly doubt that. But at the same time, the median U.S. home price to income ratio.
Median U.S. home price to income ratio. How much your home costs versus how much you make.
Yes.
Okay.
That number is at pre-2008 crisis levels.
Okay. So it's not a good place.
So it's not a good place. So homes by that metric at least are
so that has grown.
Yeah,
the distinction between those areas.
Substantially grown. So people's incomes aren't keeping up with the pace at which housing's gone. So the Fed is trying to fight that among other areas of inflation like what we see at the grocery store. And that has significant implications to your investment portfolio. So if you're an endowment or a foundation and you're invested in mostly stocks and bonds, well, you're going to be in trouble when the Fed comes along and starts raising rates aggressively because a rising rate environment is not friendly to bonds because all those bonds that were issued at lower interest rates suddenly aren't as valuable anymore. Right now you can go... a lot of money market funds right now, including brokerage money market funds, will give you a 4% rate of return.
Oh, I've noticed that. I see that on signs.
Yes.
I never do it. But
so why do you want the bond that was issued a couple years ago at half that?
Right.
So people are selling the old bonds, to buy, to get the better stuff, and which of course reduces the price of those bonds, which inherently actually increases the return you get if you buy one of those bonds at a lower price. You buy it at a discounted price and you get a nice return. And so it all evens out, but a rising rate environment is generally bad for the bond market and generally bad for the stock market. And so, well, what do? Well, one, you invest in non-correlated assets. So, well, maybe instead of having a portfolio that's strictly allocated to stocks and bonds, maybe you work in some commodity exposure. I mean, gold didn't do too badly last year. It didn't really go up much, but it didn't go down much. What about oil, energy? The energy sector did quite well last year. And so you want to diversify your portfolio to be exposed to certain asset classes that can do well even in a rising rate inflationary environment. So you want to have a flexible investment policy that allows that, but you also want a money manager who is aware of those factors and isn't just going to sit there and say a 60-40 stock bond portfolio and just take it in the teeth.
Yeah, sure.
And just ride it through. You want someone who's going to be adaptive, because here's the other thing, and I'm trying not to get too technical here, but all fixed income investments are not the same. So a lot of times people think about, we're going to invest in bonds. That's safe. Well, in a rising rate environment, the U.S. aggregate bond index, so an index of all the bonds traded in the U.S., investment grade and treasuries, it lost 13% last year. So bonds, that's not necessarily a guaranteed safe investment because, the bond index went and lost 13% of its value in a year. So you need to know how to trade the bond market, which means you need to know how to trade up and down the yield curve. Do you want to buy long-term bonds or do you want to buy short-term bonds? If you buy long-term bonds, you have opportunity for capital gains. So if interest rates come down, you can make some real money there. But in a rising rate environment, you don't want to be there because those are selling off more than any of the others. You want to be on the short end and maybe the money market or cash end, collecting those high money market rates and benefiting from rising rates and staying out of the long end of the bond, yield curve. And so, a money manager that might just park their bond portfolio in just a blended duration bond portfolio and just kind of forget about it for a year, you're going to get smoked. And it's a bad situation. So you can trade the exact same asset allocation differently and in a way that is more beneficial to your institution. And so that's where you want somebody that's a little more educated on actively managing a portfolio.
Interesting.
And so that's where, to any of your listeners who are, CFOs or presidents who are looking at their endowments, you want your money managers to be active managers. Not day traders, not people.
Yeah, exactly. What type of people should we be seeking out to be our money manager? Like we want people who are going to be thinking about, like, obviously reducing risk. Right. I mean, that seems like an obvious thing. But at the same time, you just outlined, to me, one of these mixed accounts would have sounded good. It's like, okay, great. It's just kind of in a several places so I won't get hurt. But you're saying it needs more specific management. Right.
Not just mixed between stocks, bonds, and even commodities, but also somebody that can trade within those asset classes well. So obviously, I would suggest myself, Providence Capital Management, let me come and talk to you. But you, whether it's me or someone else, you want somebody who's going to be adaptive to what the market throws their way, who looks at the challenges that the market's throwing their way and tries to turn them into opportunities.
Right. And there are, even in these type of strange situations, opportunities.
Absolutely.
So, like, I know you can't tell us what those opportunities are right now. If they do, but they can find you, right? And
absolutely.
So tell us a little about where people can find out about you. And,
sure. Yeah. Absolutely. So, obviously there's my website, providencecm.com.
Yeah.
And then there's my email address. If somebody wants to email me, I'd be happy to talk to them.
And we'll have that in the show notes here, so you can just click on that too.
Perfect. Yeah. Yes. Ethan@providencecm.com. Please click on that, and we'll be happy to talk. And I would say, my ideal client, because fit is so important, between an investment advisor and a client. When I was going through the Yale program, most of the people graduating from there were, as far as those that were in the institutional space, were going to be chasing after endowments of $100 million and more. Less of them were going to be chasing after endowments of $25 million to $100 million. And almost none of them were going after the sub $25 million space.
Okay.
So, and hey, I mean, if somebody with a $100 million endowment wants to talk to me, I'd be happy to talk to them.
You could talk to me too.
Yeah.
I just like to talk to you.
Just like to meet you. Yeah. But honestly, I want to focus on the underserved space.
Interesting.
Of less than 25 million, because I think that's where most of the good and most of the help can be done right now.
Okay.
Is helping those foundations and endowments with less than $25 million invest. So I would say anywhere between, $250,000 to $25 million is kind of my target range for institutional clients, or any individuals that are in that range as well. But I would say that's kind of the endowment and foundation range that I'm aiming for, and that I think I can do the most good in.
So when you have this, you're focused on this one very particular. And when you told me that number, I thought, well, that sounds high. But thinking of it in light of what the market is, it's interesting. Now, the name of your company is Providence.
Yes.
What's up with that?
Providence Capital Management.
Yeah, obviously, like you have something in mind.
Yes.
Like you're trying to tap into an idea.
Yes.
Theology.
Yes. It's the idea of provision. It's funny because Providence. I'm in a Wesleyan institution. I work with you guys.
We still believe in it.
But we believe in it.
Amen.
And so yes. So when I started the firm, the idea of, we're here to provide for a better future. We're here, whether it's us as, individuals and families, or it's as institutions, we're here to provide for a better future for whatever God's calling us to provide for. And so I want to help nonprofits and foundations provide better for their mission. Mm-hmm. And so honestly, the name of my business is also the mission.
Amen.
Of the business.
Awesome.
So that's
I love the word too, because it also has a sense of a passive quality.
Yes.
Like providence. I mean, it's not like etymologically or grammatically necessarily that, but there's a sense of providence is something that happens outside of you.
Yes.
And like the nature of this conversation is such that you come alongside people like me who don't think about these things. Like, and you're providing for them, giving this providence.
Right.
And ultimately, like, that's what we're looking to with what God provides for the world.
Absolutely.
Is that it's His providential hand that guides us. Okay, my last question is this. I ask people, my name of the podcast is More to the Story. So I wonder, is there more to the story of Ethan than you normally tell than when you're talking about finances? Is it something you like to do? Or?
Oh, that's a great question. I mean, I'm not a good golfer. I enjoy golf. People often, I love asking people, what books are you reading?
Oh, interesting.
Because that's a great insight, great window into their interests and to just who they are. And so I'm a history buff, as we talked about earlier in the podcast. And so right now I'm reading Winston Churchill's History of World War II. It's his firsthand account of World War II. It's 6 volumes. I'm in volume number 4 right now. And we just got through the Casablanca conference, and he's, trying to balance right now between all the competing French factions who want to be the leaders of the Free French and the Americans and the British interests. And it's fascinating. Churchill's History of World War II is a fascinating read. So I've enjoyed reading it. So for any history buffs out there, that's a good read.
Oh, that's good. Well, Ethan, thanks so much for coming along. Appreciate having you. And also like helping people think about this. And it's interesting to see how God has led your story through law school, history major, to be able to help institutions at this level to sense and lean into God's providence.
Thank you so much, Andy. It's a pleasure being on here.